Assalamualaikum warahmatullahi wabarakatuh. My name Muhammad Fazly bin ZULKIFLI from JBA2423D, and my other friend AKMAL AZIQ, SYAKIR DANIAL, NASRUL AIMAN, and also FARID. Today I want to present topic capital structure. For the introduction, the combination of debt and equity that makes up a company total capital is referred to as its capital structure. It symbolizes how a company use a combination of common equity, preferred stock, and long-term debt to finance its assets. Business must take critical decision about capital structure because this choice will affect the company overall performance and financial health. The question of how a business should raise money to meet its operation and investment need is at the center of the capital structure concept. Finding the ideal ratio of debt to equity is a difficult undertaking that calls for considering several variables, including the cost of capital, risk tolerance, financial flexibility, and the state of the market. Debt capital is borrow money through bonds or loans that the business must eventually repay, whereas equity capital is raised through the issuance of stock and represent ownership in the company. Every element of the capital structure has benefit and drawbacks, and the best combination relies on the particular and objective of the business. The choice of capital structure has a significant impact on the risk, profitability, and cost of capital for the company. A well-designed capital mix can improve business capacity to both weather economic downturns and produce return for its owner. On the other hand, an improper capital structure can put the business in danger of financial trouble and impede its ability to grow. To sum up, the capital structure plays a crucial role in financial management by influencing a company's overall financial structure. Careful thought and strategy planning go into capital strategy. Careful thought and strategic planning go into capital structure decision to make sure the mix selected will maximize shareholder value and meet the company goals.
Capital structure refers to the mix of different sources of capital that a company uses to finance its overall operation and growth. It symbolizes the appropriate ratio of debt to equity in the business. To put it another way, it illustrates how a business uses a mix of debt and equity to finance its assets. Debt capital is any kind of debt that the business incurs, including loans. This type of loan is borrowing money that must be paid back with interest over a predetermined time frame. Debt can be represented by bonds, banks, loan, or another financial instruments. Equity capital, which is supplied by the shareholders, symbolizes the ownership's stake in a business. Unlike debt, equity capital grants investor a portion of the company ownerships, rather than requiring repayment. Retaining earning, preferred stock, or common stock are examples of equity. In advanced corporate finance, the idea of capital structure becomes increasingly complex, requiring a closer examination of its many elements and their effect on a company's ability to make financial decisions. Modigliani-Miller theorem is some advanced aspect of capital structure in corporate finance. This theory offers a theoretical foundation for comprehending connection between a company's value and its capital structures. It was formulated by Franco Modigliani and Milton Miller. The Modigliani and Miller theorem assert that a firm's worth is independent of its capital structure in a world devoid of tax, bankruptcy fee, and another market inefficiency. The ideal capital structures can, however, be impacted by a few real-world variables, including tax and the cost of a financial crisis. According to the trade-off theory of capital structures, there is an ideal debt level for a business that strikes a balance between the tax benefits of debt and the expenses associated with a financial hardship. Business must balance the tax shielding advantage of a low interest against the possible expense of a bankruptcy and the debt-related agency fees.
Next, I want to explain about how to determine optimal capital structure. So first, we must know about what is optimal capital structure. The optimal capital structure is a mix of debt and equity that reduce the cost of capital while increasing firm value. So how to determine optimal capital structure? First, we look at WACC. When a firm cost of capital, WACC, is minimized and its firm value is maximized, it has the optimal capital structure. According to the trade-off principle, corporation must weigh the benefit of the tax deductibility against the danger of bankruptcy and financial difficulty. It is because of the trade-off between the tax benefit from the debt and interest expense. Each firm has an optimal capital structure in which the WACC is minimized and firm value is maximized. Second, the debt to equity ratio. The debt to equity ratio is often used to determine the appropriate capital structure. It is credit indicator that compare a company's total debt to the value of its shareholder equity as reported for bookkeeping purposes. By modifying the debt to equity ratio, the company capitalization, which is the element that influence the cost of capital WACC, vary appropriately, such as the bankruptcy risk. We finish with that. Let's move on to the factor affect capital structure and capital structure decision. The capital structure of company comprising its debt and equity financing arrangement is a crucial factor that impacts its overall value, financial risk, and cost of capital. Finding the ideal capital structure is a difficult decision that is influenced by several factors. One of the factors is free cash flow, FCF. A company's capital structure frequently reflects its present fundamental characteristics, such as its past and predictive profit margin and its expected ability to generate free cash flow. The company's free cash flow must be sufficient to meet its debt servicing commitment on schedule. Next, collateral or fixed asset base. Collateral of cooperation also has an impact on its capital weight. Companies that use business strategies in which the core value is derived from tangible asset rather than intangible asset can obtain debt funding more easily. While there are exceptions, having a substantial fixed asset base might be advantageous for borrowers because in the event of default, the lender has the right to collect the pledged collateral and regain most of their original investment or be repaid in whole. Finally, tangible asset. In short, the more reliant a company's operating performance is on intangible asset, the less likely management is to use debt as a funding source. Intangible asset, unlike tangible asset, cannot be physically touched and cannot be pledged as collateral.
Financial distress refers to a situation wherein a business fails to pay its debts, possibly resulting in bankruptcy or other dire financial consequences. Necessary financial crisis. Experienced corporate finance professionals examine debt reason, effect, and possible solution in great depth. High leverage is one of the causes financial distress, when a corporation may find it difficult to pay off its debts if it has too much debt, particularly if its cash flow starts to fall. Other than that, it's a poor financial management that financial distress can be caused by inefficient financial management techniques such as poor cash flow management, working capital control, and budgeting. Economic downturn is also one of the causes financial distress. Financial distress can result from external circumstances that negatively affect the company revenue and profitability, such as industry-specific downturn or economic recession. Finally, is operational issues. Operations, manufacturing, or supply chain disruption issues can have an impact on a business capacity to turn a profit and pay its debts. Financial distress costs refer to the various expenses and adverse consequences incurred by a company experiencing financial difficulties. These costs can be categorized into several key components. Firstly, bankruptcy costs arise from the formal process of resolving financial distress and include expenses like legal fees, administrative costs, and potential discount on asset liquidation. Secondly, agency costs emerge due to conflict of interest among stakeholders, leading to managerial opportunism and conflicts between the debt holder and shareholders. Additionally, financial distress can result in a loss of reputation, impacting the company's ability to maintain a relationship with the suppliers, customers, and investors. Collectively, these financial distress costs highlight the challenge associated with navigating through troubled financial waters, and companies often strive to minimize these costs while devising effective strategies to resolve their financial challenges.
Okay, next I will discuss about the integration of the effects and financial costs. This test. The integration of the tax effects and inflation distress costs in the central to corporate strategic financial decision making. Company must careful balance the benefit of tax consideration against the computational risk associations with financial distress. As the negotiation, the company retain of the capital structure in financing. The complex interpreting of the variables from the tax sheet affordable by the debt to the direct and indirect expense incurred during time of the financial hardship go into the different balance. The effective risk management become critical in the situation. Necessity a strategic approach to financial planning that matching the capital structure of the business with the post immediate tax benefit and long-term realization against future financial difficulties. There are a way for the business to make strategic and well-informed financial positions. The optimal capital structure is the optimal combination of debt and equity that a company should use to maximize in value. This decision necessitates a close relation of the trade-off between the computational cost of financial distress and the tax between the debt. Tax benefit association with debt mainly consists of the interest induction. That interest payment are usually tax indeductibles, offering a financial benefit that raises an organization profitability after tax. From the strictly financial standpoint, that financing is the paying because of the tax sheet. Conversely, an over-reliance on debt can risk a business financial risk. particularly in the time economic necessity or unfavorable market condition. Direct costs associated with financial distress include those associated with legal fee, bankrupt procedure, and restructuring. To sum up, one of the most important aspects of the corporate financial management is the complex relation between tax implication and financial distress costs. Business must carefully weigh the benefit of the tax consideration against the possible risk of the financial distress as they attempt to negotiation the changing landscape of capital structure and financial decision. The delicate balance necessity and sophisticated comprehension of the long-term effect of potential financial difficulties, as well as the short-term financial advantage such as tax shield contains from that.
Hi, my name is SYAKIR. Now I will present you about agency cost of equity. Agency costs refer to the expense incurred by the business because of a problem such as communication breakdown between the shareholder and the management, and a conflict between management and the shareholder interest. An agency cost of equity arises when management take action that shareholder believe will not enhance the value of the share and may not be in the best interest of the company. And measures taken to supervise and prevent this will come at a cost. Therefore, the agency will incur costs not only due to poor decision, but also due to the cost of monitoring the management to prevent them from making such decision in the future. It is important for the company to be aware of how difficult it can be to eliminate agency costs completely. However, in order to reduce agency costs, incentive schemes must be used properly. Management will have to act despite the cost if disagreements and competing interests were allowed to fester. For example, although shareholders may believe that a measure will not help in the company's expansions and the money spent on it will be better used for the dividend payment or other investment, management may believe that a measure will be the best course of action for the company's success. The agency cost of equity will be the expenses related to avoid the merge, including lobbying.
Next, I will present about the packing stock order theory. So, the packing stock order theory is the well-known concept in the corporate finance that delves into the complex decision-making process that business go through when seeking funding for investment project. According to the theory, businesses have an innate tendency to give its internal funds like retained earning proprietary over external financial resource. The theory suggests that when external funding is required, there is a clear difference for debt over equity due to factors like information asymmetry, signaling effect, and the need to maintain management control. The hierarchy in the based on the idea that managers have the better knowledge of the financial standing of their organization than anyone else, which includes the decision to cut, expand, and negotiate the tricky world of the corporate finance. The importance of the external financing is the cornerstone of the picking on the theory. This means that a business must finance its investment entirely through internally generated revenue, especially retained earnings. Internal funding is preferred to several reasons. Since internal funds do not communicate with the market, they can help prevent problems caused by information asymmetry. Managers have the first-hand knowledge of the company performance prospect in contrast to external investors who may not be as familiar with the company financial situations. The next step of the taking order is the debt financing if the company external resources are not enough to cover an investment requirement. For several reasons, debt is preferable to equity, and this calculate decision consider the following factors. Debt financing raises less of the information symmetry issue than equity issue. Debt holders are more concerned with the company capacity to pay off in debt than with the day-to-day operation. This includes interest and principal payment. This simplifies the decision to take on debt when outside funding is required.
Hi, now I will discuss about signaling hypothesis. Signaling refers to the process by which individual or entities convey information to others to influence their behavior or perception. Signaling is the practice of utilizing confidential information to open a trading account, what we call insider trading, account when a corporate insider reveals important information about the firm, leading to increased trading activity in the stock by those who will not otherwise have access to such data. Outsiders see the insider's behavior as an indicator of market sentiment. The capital structure signaling theory was developed in the late 1970s by Rose and other specialists in response to the problem caused by the uneven knowledge between investor and manager. Those models are based on the notion that in order for a company's stock price to grow, senior executives with inside knowledge will be motivated to share that knowledge with the outside investor. Nevertheless, managers are unable to merely proclaim beneficial advice to investors, since they are born to receive such information with a sense of doubt. One answer to this problem for unvalued enterprise is to create a financial strategy that sends a signal to investors including this information. This method is prohibited in terms of a cost for a lower value corporation. The expense of the signal is what makes it believed to external user. Despite the costliness and cost of the signal, managers will not broadcast their excellent news because any company may do so without being valid. Instead, the administration strengthened the firm's leverage. This capital structure represents a defined commitment that a corporation with average potential will not dare to make. Firms that wish to communicate the message that they have a strong future raise their leverage. In contrast, overvalued firms are unwilling to bear the burden of leading signs going to expose them to the danger of bankruptcy. Furthermore, the signal's accuracy is important. Last but not least, managers frequently utilizing capital structure are the ratio to convey certain data on the firm's profitability and risk to external users. The basis of signaling theory is that insiders have more information than insider managers' computation. And privilege may also be tied to the stock price of the firm. This provides the company with an intense incentive to educate investors about how much they are underestimating them. The rise in leverage is a strong signal. The long arrangement requires the business to have constant cash flow over the long period, and failure to do so will result in the serious consequences such as bankruptcy. In the case of equities, however, things are more flexible. Stockholders generally expect certain cash dividends, but in the case The administration can reduce or cancel them during financial downturns. As a result, obtaining a new loan is a reliable indicator of the future cash flow to pay commitment.
Structure play a crucial role in its financial management approach. The choice made about how to fund operation and investment using a mix of debt and equity have a significant impact on the organization overall performance and well-being. A company's ability to undertake profitable projects, optimize cost of capital, and maintain financial flexibility can all be enhanced by a well-balanced capital structure. Establishing an appropriate balance between debt and equity enables a business to use financial leverage efficiently without taking unnecessary risk. On the other hand, an improper capital structure may result in higher expenses, unstable finance, and a greater chance of trouble. When choosing their capital structure, business must carefully consider the risk tolerance, the state of the market, and their long-term financial objective. The capital structure must be reviewed and adjusted on a regular basis due to the dynamic nature of the financial market and the state of the economy. To guarantee that their capital structure stay in line with their changing needs, business must be flexible in their response to shift in interest rates, market circumstances, and business strategies. To put it briefly, choosing a capital structure involves careful consideration of the circumstances of each company, and is not a one-size-fits-all decision. In the ever-changing business environment, companies can position themselves for sustainable growth, financial resilience, and increased shareholder value by making thoughtful and strategic decision about the proportion of debt to equity. That's all. Thank you.